Welcome to the Pure Property Podcast. Whether you are considering buying your first investment property or reaching property mogul status, we dissect the fundamentals through to large-scale property development and everything in between.
G'day, Phil Tarrant. Hope you're well. Welcome to the Pure Property Podcast. I still struggle with that. Too many P's. Paul Glossop joined me in the studio. He's the founder, managing director of Pure Property Investment. We get together once a month, have a chat about what's going on in real estate. We've been doing this for a little while, and I've had Paul on the Property Investment Podcast Network over many years now, so we're able to actually have a reflection sometimes on what we've been talking about in the past and see whether or not what we said then was what we think it is right now. We do it a lot. Today's going to be very much geared towards that. Paul, how you going?
I'm good, mate. I'm good. I'm a bit nervous about today because, you talk about reflection. Sometimes there could be some deflection. But I guess one of the challenges when you do this for a long time and you put things to air years and years and years, and in our case, probably close to a decade ago now, is that you get sometimes things that have said that there's a risk of them not coming to fruition.
You know what's really good? And I was working on something the other day, and it's not very often I write anything, right? I normally just talk on.
Yep.
I talk on air.
Lazy.
And, yeah, it is. It actually is, right? But I was sitting there, right, and the point is that if you put something down in words, it's a lot more formal, right?
Yeah.
Like it's not really it's just got more gravitas to it. Whereas if you say something verbally, like it's a lot more forgiving.
Yeah.
It's really funny because I was trying to pen an opinion piece on something. I won't go into bore you with the details around some banks and some mergers and stuff. And when you write it, you go, oh, that's
You get nervous.
You get nervous, right? You sit there, you can see legal departments in like major banks or wherever it is going through it word by word, trying to work out whether you're defaming someone or whatever else, right? Or having a crack at you, right? So, and it's really hard to retract it once it's written. But you say something on a podcast, you go, oh, I reckon this, right?
Put it into context.
You rock up the next week and go, oh, I said that last week. Yeah, it wasn't right.
Yeah.
This is what I think now. People go, okay, cool.
I can't delete that from the internet.
You can't delete it from the internet, but it's so much more forgiving. You go, well, like, yeah, that's what I thought at that point in time. Obviously, things have changed, so I didn't get it right. This is what I think right now.
Yeah.
And I reckon we've said it, probably you more, many times over the rising interest rate cycle, going, that's it. There can't be any more interest rate rises, right?
Yep.
Like that. This is the top. This is we're at the peak of the rate cycle. Then it's gone up again.
Yeah,
and it happened last
last
November, right? And I think we
I think we
have
said
one.
50-50 at that time too. And like the jury's been out, we might have another one. I mean, we've got to wait till next month to figure out is there going to be another one? I think it sounds like we could be 50-50, 60-40. There's a bit more info to come out here now to wait what happens. But I think one thing we always look at is that, these, and I think we seem to always bring up Tom Panos in my podcast very frequently.
I don't talk about Tom anymore.
No, I don't. Well, I'm hoping for a bit of love to come back.
He's in Denmark at the moment. I saw him on the internet.
I do.
Still doing his property updates.
Yep, in his black vests and enjoying himself.
He's looking fit at the moment.
He does.
Actually.
He's looking very tanned. But I think one thing he said, if I go back to it, if I probably bastardise this a little bit, but it's interest rates are temporary and the property itself is permanent in some way. I know I've doctored that in some way, shape or form, but I think basically what he gets at is, and what we talk about a lot is, interest rates, look, they will move. I guarantee that within the next 3, 4, 5 years, there's going to be fluctuations. The likelihood is that the general momentum over the next couple of years will probably be down at some stage. Yeah. But are you buying a property because of the interest rates of the day, or are you buying a property because of the fundamental ability for that property to rise in value and provide you with financial security over time? Yeah,
and it's got to be, there's a lot of implications of interest rate rises, and they're normally immediate around the time that those interest rates happen. If there is to be another interest rate rise this year, already some of the banks have come out, NAB come out earlier this week revising their forecasts around interest rates, and I think they're now out to April of next year for the first cut.
Yep.
And then maybe another one later in the year by memory. And then I don't know what the other banks are doing yet, but that's just forecasting, right? They get it wronger
well, that's
than what
we're
we
talking
get
about
it right.
today, right?
They get it a lot wronger. And if
remembering
you
the
think back
start of COVID,
yeah, God, they got it wrong. But
CBA, 33% drop within 18 months, 2 years, something to that effect.
And I reckon the stuff that we get wrong isn't like really wrong, if that's a real thing. What we normally get right is the stuff that you need to get right. And I think there's variations in forecasting and predictions, interest rates versus what actually happens to property markets. Yes, they are interconnected, but they often act individually. Now, you've got the looming federal election. I reckon, and I hear there's a lot of jitters right now around that because in the federal budget in May, the government was pretty clear that they thought inflation was going to be under control by the end of the year, or if not early next year, within a target range of 2 to 3%. And they put a lot of emphasis on that. Here we are talking about potentially another interest rate rise because inflation is staying around. It's actually going north slightly. I don't know we're still waiting for some data to land this month to see how actually that's going to go. But this if there is an interest rate rise, I reckon there'd be some pretty concerned folks in government at the moment and how that's going to really shape people's decision making around it. Now, should people be making decisions based on one interest rate rise at a point in time? Yes, there's a cost of living crisis and all this sort of stuff. But it's got to be a contentious issue. Like if they do raise rates next month or before the end of the year, it will have quite significant ramifications, I think, towards perceptions and sentiment. Now, perceptions and sentiment are pretty critical because that's what normally shapes people's decision making. And if you think back to, it's what I want to talk to you today about, COVID, that there was this big, realisation that something significant was happening to Australia and the world at a point in time in February, March and April of 2020. We all went through that journey. Everyone had their own response and sentiments towards it. There's a lot of fear in the market, which shaped people's sentiments and attitudes shaped behaviour. Now, back then, and we were supposed to do it in person. I think it was before the lockdowns, but you had a sniffle and you couldn't come into the to our studio here to
Pretty
record
sure you
it.
would have had the sniffle. No, probably not. I did have the sniffle.
You did have the sniffle, and you're being very conscientious and thinking that the COVID boogeyman was going to come and decimate everything, right?
I was protecting you, Philip.
Oh, you were, and I don't want to dismiss.
You're welcome. I'm a hero.
COVID was a tough time for most of us, and
you and I
have
included.
Different reactions to people, and people's shared experience and individual experience through COVID. But for the context of property, we got together and we said, "What are you going to do?" That was the key thesis. This is going on. What's going to happen? What do you do with it? And it was our view and our objective in doing that was to give some sense to the market and hopefully shape people's decision making, influence it in a positive way. So hopefully they would make the right decisions. Now, at that point in time, your position was, this is happening. People go, I'm a big student of history. People go, what do you care about history? Well, history often dictates and determines or gives you clues for what the future's going to hold. And I think you said at that time, and you're probably better saying than I will, but the last 5 major impacts on property markets, certain things happened. So what I want to pull apart today is that, has that happened this time around?
Yeah. And
I think you'll probably tell me that what we spoke about at that point in time largely played out. But there was fear in the market. You said 30+% drops in property prices from Australia's major bank.
That's it.
Telling Australians that was what was going to happen. So
Absolutely.
People made responses and reactions to that. Did your clients stop buying at that point in time? I'm trying to get a sense for investing counter-cyclical. So when everyone's fearful, you should be taking action.
Completely. And I think to give some context, and anyone who wants to go and vet this, they can jump on the Smart Property Investment website. And I think we recorded a webcast with SPI specifically, so Pure Property Investment, SPI partner, to put this out there. And I'm pretty sure it's still on there. If it's not, we could probably get a link to it because I know it still exists out there.
We'll put it in the show notes.
We will put it in the show notes because I think that goes through a lot more data and detail, which I don't want to belabor too much for the sake of our catch-up today. But we looked at the last 5 major downturns going back to early 1980s and then looked at, okay, well, let's look at what happened to property both on a city level, on a regional level and on a national level to figure out what actually happened to the markets in the following 4 or 5 years. And to answer your question, Phil, in short, yes, we had a lot of clients get very fearful very quickly. And to give some context, we had roughly about 35% of our total client cohort within about 6 weeks in March 2020 wanted to stop their search and pause to figure out what was going on. And it's very understandable. I mean, our position wasn't saying, hey, you're making a massive mistake here, but we don't want to give context or give opinion that's subjective. What we want to do is say, okay, let's look at what's happened previously. When these major downturns happen, what happens in the market? What happens in the economy? What are the things that are going to effectively change the course of what's happening in property? And we looked at things such as what is the government stimulus, the government response, rental assistance, what happens to interest rates.
And that was before any of these things were handed down.
That was before any of this. Was in March, right? It was only just then when things were starting to be discussed about interest rates possibly coming down, about things like JobKeeper, about JobSaver, all these terms. I forget about them, but man, they were common vernacular for like 24 months, right? Like you're thinking about
what was the COVID? So COVID created its own lexicon. I think
Absolutely.
It was like Qantas had I'm standing down my workers. What does that mean? I'm standing you down. You stood down. I'm just not going to pay you.
Yeah, well, that was it. Like that. All the airlines, they basically stopped paying people, and they said, "Well, you're standing down. Are you sacking us? No, we're just standing you down because we don't have any demand. We can't fly." Yeah. And all these things happen. But I mean,
March 24th, 2020. I'm happy to report that it is live. It's there. It's called Webcast. COVID-19: The Impact on Property Investing, and it says here, the founder and director of Pure Property Investment will reveal the markets delivering cash flow, positive property supported by strong infrastructure developments. You'll also find out, et cetera, what's going on.
So do yourselves a favour, go jump on that, because I think for me that gives such good context because, again, go back to what we open with. You can put things out there in the internet which can't go away forever. And, we made some pretty broad statements because that was after, I'm pretty sure Mark Corman, the head of CBA at the time, said, I think at that time, well, his bank came out with the expectation in their forecast of
Matty Corman. They came out and everyone followed and everyone went, oh my God.
You saw basically everyone else come onto the same, and we said, well, hey, we actually think it's going to do the opposite. So to answer your first question, Phil, yes, we had about 35% of all of our clients within a 6-week time frame from March to April say we want to stop or we want to pause because we are scared.
How many people caught up and said, let's go?
A few.
Yeah.
But you know what, Phil, and this won't surprise you and probably won't surprise our listeners, the ones who said, let's go, let's load up, they've been there before. And this was what comes down to it, is that experience is everything in this game.
And that's mindset. And mindset is shaped by sentiment. Sentiments is shaped by the way in which your collective scar tissue that you have as a property investor, who you surround yourself around, where you take advice from. I remember speaking to my accountant at that point in time. He's going, this is good, Phil. This is good.
And that's exactly how it was said too, quietly.
Yeah. And again, I'd like to delineate the fact that we're talking about property prices through COVID, not the substantial impact it had on a lot of people.
Absolutely.
And there's still people recovering from COVID. There was a tough time, and it was just after those summer bushfires as well.
It was,
and there's a lot of people still struggling off the back of that. So just to be clear, we're putting that apart. And I don't want to dilute the impact of COVID on people, their households, their families, their health, all that sort of stuff. And there's still people now today. People go, oh, I've got this health problem now. I think it could be because I took got a COVID vaccine. Right? There's still a lot to wash out.
There's people who are suffering from COVID, from long COVID, all the other things.
All that sort of stuff. So what you've given me here, and I know you're a data guy, and at that point in time you presented some data, which was, this is the last 5 major market, seismic shifts, right? Yep. And what has happened over that, I think your point then was, you've always seen sustained growth after a major incident to the market, was your point. So you were saying that's what's happened previously, so therefore that's what should happen into the future. So
in that webcast, I'm pretty sure we put the figure and the accumulative figure of the last 5 downturns, because we crunch those numbers, and the accumulative figure was approximately 33% capital growth as a nation in property from a residential standpoint. Houses, apartments, everything that falls into that over the forthcoming 5 years was the general average. Okay,
so let's pick up then what the data is telling us today, because CoreLogic has just put out some data this week, I believe it was, connected specifically with this. So what has been the growth in these markets since the onset of COVID? Let's call it March of 20, so 4 years on, right? Thereabouts. And I'll quickly rattle through some numbers here, Paul. Sydney has grown by 28.2% since the onset of COVID, and it's at its peak right now. And it's grown. So that's grown. And I imagine these are medium prices.
Yes.
Sydney's grown by about $250,000 since that period of time. Melbourne, has grown 11.2% since the onset of COVID, $78,000. It peaked in March 22, so it's come
2
back.
years ago.
It's come back
Correct.
from the peak, and we'll pull this apart because I think you'll start seeing there's
some
clues. There's clues
Yep.
here, right? Brisbane has grown by 61.5% since the onset of COVID over 4 years, 327,000. It's at its peak. Adelaide has grown by 63.9%, $300,000. It's currently at its peak. Perth is 66.6% since the onset, $300,000. It's at its peak. Hobart has grown by 28%, or $141,000. It peaked in March 22. Darwin has grown by 27.5%, or $100,000. It has negative growth, negative 5.7% since the change of since its peak. It peaked in May of
It's 20.
14.
It's 24. Yeah, that's not correct.
That's
I think you've made a
24.
little typo there.
Yeah,
I'll call it.
yeah.
Yeah.
So Canberra has grown by 32% since the onset, or $211,000. It peaked in May 22, so it's come back a little bit, 5.4%. All these markets have grown.
Yes.
Some of them has grown by 66% at the top end. The worst performer is Melbourne at 11%. There's some clues there, and you can pull Melbourne apart. There's a lot of reasons why Melbourne is in the humdrum.
Remember, this
and
includes
lacklustre.
apartments, houses, everything.
It's the whole kit and
Yep.
caboodle. So if you were invested in a market at that point in time, or you took action, you would have ridden that growth.
Yep.
Cool. They're capital city markets. Regionally, regional New South Wales has grown since the onset of COVID by 48%. It peaked in May of 22, so it's come back 3.2%. Pretty good. Regional Victoria has grown by 33%. It also peaked in May 22. It's come back 6.7%. Regional Queensland has grown by 62%. It's at its peak. Regional SA has grown by 62%. It's at its peak. Regional WA has grown by 64%. It's at its peak. And regional Tasmania has grown since the onset of COVID by 46%. It peaked in May 22. There's a lot of May 22s in there. What happened in May 22?
Interest rates.
Interest rates started going up.
Yep.
So collectively, combined capitals, it's grown by 32%, or $216,000. So everyone, if they were there at the start of COVID and held onto assets, you've had growth. If you've invested during that period of time, you've had growth. Regional combined regionals grown by 52%. So there's certainly some clues here about where you should have deployed your money. It's grown by 52%, currently at its peak, 216. So look at that, right? So this is talking about medians. At a actual dollar value level, they've grown about the same amount. So if you deployed money, this is about the utility of your capital. It performs so much better regionally
Yes.
than it did at a combined capital city level. You would have got about the same impact.
Dollar value.
Dollar value.
Yep.
Dollar for dollar, you would have been about
Excluding
the same.
yield.
Excluding yield.
Yep.
And I would argue probably the yield was probably better in regional.
Absolutely.
So the catch-all there is that regional's been a better investment proposition than capital cities for the period of time since COVID to now.
Yes.
That's okay. Nationally, everything, it's 36%.
Yep.
Okay, great. So what happened from the onset of COVID and what we said back then to where we are right now, property's been a good investment.
And it's pretty close to almost smack bang in line with the last 5 major downturns, which we said was
33%.
33%.
And that's 32% capital cities, 52% regional, wash up 36%.
Yep. And it's, for me, this is where this
We'll put this in the show notes. There's a lot of information there.
absolutely.
Yeah.
But I think the fundamental components of this is there's probably 2 parts to what we see here. Is A, there were people in 2020 who took action, and there were people in 2020 who had the ability and maybe even were early in that year thinking about doing something, but then push pause based on the fact that they maybe A, didn't have the experience or the confidence or the foresight to know what was going to happen, and they may have done nothing for the last 4 years. They may have done something a couple of years later, but all of those decisions had dramatic impacts. The people who were the biggest winners out of COVID from a property growth standpoint were those who took action in 2020. Those who took action pretty much immediately. And regardless, as that data said there, regardless of which major city it was in, if we just look at the majors, each one of those increased. But quite obviously, the major winners were going to be Brisbane, Adelaide and Perth. Now, the other thing that this doesn't necessarily elicit is when that growth took place. And
that's where it's at. And I would say that most of that growth happened before 22.
In many
before
of those
May
markets.
22, I would say most of the growth happened when interest rates were low.
In markets such as Sydney, Melbourne, probably Hobart and Canberra, yes, 100%. They were leading the charge. You know, the reality is Brisbane was starting to grow. Adelaide was starting to grow early in COVID. It really boomed in 21, 22, took a backward step. But now, if you look at...
I'm sure that data's available, right? They would map, the core logic would map that.
Yeah, absolutely. But I mean, this is the thing, though. Like, the interesting part here is that you've got 60% growth in Brisbane, Adelaide and Perth over the last 4 years. If I look at Perth in isolation, Perth's going to have its best capital growth 12 months now. So it is actually still at its highest level of raw quarterly capital growth right now. Some of those markets are actually on the other end of it, and that's where the affordability is starting to pinch. And you look at the markets such as Sydney, probably more specifically Melbourne. But if I was a Melbourne investor and you chose to deploy your money there in 2020 and you looked at those numbers and you had other options on your register, that's when you're sort of thinking, that's where I've made a decision. Got it wrong. And unfortunately, getting it wrong from a dollar value wise, it's pretty substantial.
I would say that through this period of time, we've been saying don't invest in Melbourne.
We haven't invested in Melbourne.
You haven't. I think
recently.
I've been talking about don't invest in Melbourne. I've got assets in Melbourne.
Yeah,
that's cool.
Yeah,
and
we have
performed as well.
And I think to your point, Phil, like you start to then figure out where are the clues here, because if I look at average household incomes versus things like at median prices right now, and we're 4 years post-COVID, and we start to see where is affordability, and then overlaying that again with that long-term 30-year data, believe it or not, Melbourne still is to this day the number one performing Australian capital city if you average out the compounded average annual growth over the last 30 years. Even though it's been the worst performer over the last 4 years, it's still the best performer per annum compounded over the last 30 years. But then you say, well, what's it done over the last 4 years? Nothing.
There's a hot tip.
It starts to then, but again, I don't want to probably pick these things out in isolation. It probably just starts to explain where value was and where value maybe isn't as much anymore.
So question for you, and I know we will, we team up with the team over at Pure Property every year to do our big Fast 50 report, and we're going to do on the Smart Property Investment Show a bit of a catch up to see where we're halfway through, since which we released earlier this year. But I'll put it out there now. When we do that for next year, do you think Melbourne's going to be on the list?
It's a very interesting one, Phil, because when you look at 12-month growth in isolation, and again, we don't probably ever want to invest for a 12-month outcome. You want to invest for a 5, 10, 15-year outcome. Will Melbourne start to feature into the markets which will grow the strongest in 20? Well, we typically look a year ahead.
Yeah.
The list for next year will be where to invest your money over 2025 to then get the best outcome over the following 12 years. If I look at it a 12 to 24-month time frame, I think the answer is probably maybe. It's a cop-out, but I don't think it's going to be definitely no.
What I'm seeing now, and you know, I think buyers agents have probably been the biggest customers of Qantas and Virgin from the East Coast out to Perth over the last sort of couple of years. I'm hearing that market's starting to wane. You know, maybe know the smart operators aren't there anymore. They're somewhere else.
It's a tough market. I think the reality is when you see, even if I look at the last quarter of growth for Perth, it grew by close to 6% for the quarter. It grew by over 2% for the month of May.
Yeah.
If you look at that most recent
they're
data.
saying now there's dumb money going out there.
There is in certain areas. I think it's starting to become overheated for us. Probably some of the bigger lessons, and this is the lessons we've learned from every other market, is you get to the point, although there is demand and there's desirability and people still see value, there is a certain point in time where the bank will effectively say, no, we can't lend you any more money. And different people cap out different ways. But the other way that this starts to give clues is when renters, even though there is record low supply of residential property in Perth, as an example, and it's similar in Brisbane and Adelaide right now, which are both those hot markets that we can see in that data, renters are starting to top out at their affordability when we look at how do rents continue to increase, because you've got sub 1% vacancy rates right across Perth. You've got record value dollar growth as far as rental dollar growth, and in some cases that's exceeded 20% in a year. And there is demand. You've still got 30, 40 people lining up for a rental property that's a residential standard rental property, but when you start to combine, hey, we need, because again, property managers, they still need to essentially assess an application the same way a bank would assess an application for a mortgage. I want to say, what's your income?
Yeah.
What's your disposable income? They do essentially a percentage of your annual or your weekly income versus what your asking rent is, and they'll say you exceed or you don't exceed that affordability. They typically would present that to the landlord to say, we've got this application. They look good on paper, but based on what they earn, they're going to be spending 45% of their weekly take-home income for rent. Yes, they might be able to pay it this year. Will they be able to afford a rental increase? Well, only if they get a pay increase in that time. We're starting to see that is sort of starting to happen in certain areas, definitely not all areas. Yeah. And I'd probably say that that's where you've got to be far more conscious of that, not just in Perth, but in Brisbane and Adelaide, where you've seen rents increase exponentially. You've got to be more specific. And we are, full disclosure, still buying in those markets, but...
As much?
Definitely not as much.
So you're being more discerning in the assets you're acquiring.
We are. And also the fact that, to one of the points you made a second ago, is that there is a bit of dumb money in there. There's people who just are buying anything. And when we look at it, I think I made a point I think might have been on this podcast last month, is that one of my buyer's agents, Aaron, who bought an asset in Perth in his own portfolio maybe 4 or 5 years ago, ended up liquidating it 2 months ago and ended up selling it to an East Coast investor, sight unseen, and paid probably the equivalent of about $75,000 more than what he was expecting to get for it on the day. But it was just a sight unseen purchase via a medical professional who just wanted to get some exposure to the action, so to speak. You know what I mean? They're the things which I look at and that's when you start to see some silly things happen and people take risks that's just unnecessary.
I'd like to. Are you doing any commercial stuff at the moment?
We are.
Does this play out the same in commercial markets?
Well, that's a very interesting one, Phil, because if you look at the growth definitely isn't there.
Yeah, and commercial.
Commercial. It's not even close to there. But again, it's harder because when you start to aggregate commercial, you're talking from high-rise office right down to freestanding industrial. They are completely different assets. And if you're talking price points between $500,000 to $5 million, they're completely different. So do you combine them the same way you do this? You've got to pick it apart more.
Yeah, it's hard. And there's a bit of a misnomer that commercial property doesn't grow at the same speed as residential property. I think if you look over long-term averages, they're about the same, is what the numbers say. But again, it's going to be specific to
the
asset
data's
classes.
just not as rich.
A golf course is going to be very different to an industrial warehouse, right? It's whereas property doesn't change that much. Where's it located? Is it a house?
It's very predictable.
It's very predictable. So what is predictable then is this thesis back at 2020, which was, hold on, don't panic, take it easy, everything's going to be okay. If you look back in history, we've been here before. Might look a bit different, but similar consequences. You should expect sustained capital growth irrespective of these seismic. That might not happen immediately, but over a 5-year period. So what was the difference between smart investors back then versus investors that didn't do anything? You know, you said it was experience and scar tissue. And, those people that said, I'm ready to go. This is on a downwards rate cycle.
Yep.
So helping with serviceability. I think a lot of people were worried about their jobs, which probably stopped a lot structurally and functionally. That was something where a lot of people went, for PAYG type employees going, hey, am I going to have a job? Is my job still relevant? Am I going to get sacked? Do I need to move on to JobKeeper? Am I going to be on job saver? There was job everything, right? Yep. I remember when this happened, about this time is where you saw these pictures of like the Great Depression down on the Hungry Mile. Yep. Everyone lined up out the front of Centrelink around the corner, right? Like, it was a moment in time. And I think it was a picture taken for the purpose of having that for history.
I had my own mental picture, and I still remember it to this day, Phil. About 5 minutes from my house, I went down the road to a chemist to get some medicine for my daughter at the time. And I remember it vividly because I remember that the chemist that I went to is about 3 shops up from a Centrelink where I live, and I've never paid attention to a Centrelink ever. It is what it is.
Have you ever been on Centrelink?
I was on a Oz study growing up when I was at university. We're coming from a single mum. I qualified for all those benefits, and I made sure I paid back everything that I borrowed. But I was, mate. And it was a punish at the time. I remember I had multiple jobs through university, and it was still a punish to try and make sure that I could get the tuition, all the rest of the things. Yeah. But not the point of my story. The point of my story was that I do remember just looking across when I parked, I saw a line of people, and it was that moment, and I think that line was probably 40 deep, and Centrelink hadn't opened then. It was about 8:30 in the morning. I think it was about to open. I looked across and I thought, oh my God, this is real. And
there's a lot of fear in it. Like, you can see why people said,
100%.
I'm not doing anything.
Absolutely.
I'm batten down the hatches.
And to answer your question, Phil, I guess, so what differentiated people then at that point in time? Being finance ready was probably one of the key parts, and making sure that people knew they could get that money from the bank. Because, A, job security, and B, effectively what happens to property and the unknowns of everything that follows on from job security was everything. The things that were obvious is that we were going to have this huge limited supply scenario. We were going to have a whole bunch of, for me anyway, there was going to be a whole bunch of bailout and assurances from both the government, but also the government backing the banks, which both those things happened pretty much instantaneously. Yeah. The banks were then giving holidays for mortgage repayments. There was all these concessions for tenants to make sure that they had payments there. You have rental insurance to make sure that there's loss of rent extra if you took out that cover as well. So
if you remember back then for property investors, they went, you can't evict. You can't evict people, and if they can't pay their rent, they're not going to.
Yeah, so we had actually had that for a moment in time.
Moratorium,
the Greens were pushing this, and I was like, well, that's really interesting, because what do you want? You want investors to sell their property so people actually get liquidated from moved out and pushed onto the street. That's a ridiculous policy. Anyway, it happened for a period of time. Yeah. But those who took action, they didn't just take action in isolation and say, I'm going to go buy a property. They had a really good broker. They typically had confidence themselves, both in the market or with a buyer's agent, to say, don't dismay. It is going to be an absolutely prime time over the next 3 months, 6 months, 9 months, because if you are ever going to take advantage of a situation, this is the time. The RBA at the time had already flagged that we're likely to see an easing in interest rate cycle. And I actually had a listen to part of that webcast that we did. And at that time, I think there was circa 3.5% interest rates that you were able to get. And we were doing calculations to say if you could get a 4.5% to 5% gross rental yield on a residential property at 3.5% at the time, and obviously got cheaper than that, you could actually make that property cash flow neutral at P&I.
With 20% deposit.
Yeah. But no. We did those calculations. I think at the time we were doing the calculations on 100% borrowing. So if you had equity in a property that was released and you could get the money, we actually did the math to say if you actually in that position, you go buy a $500,000 asset and you can get your money to circa 3% fixed on a P&I with I think it was about a 5% rental return, you were going to be about cash flow neutral. So if you were pragmatic enough to think, hang on a second, I've got the equity released, I've got an indicative approval from my lender, as long as that tenant's there or tenant's going to replace that tenant that's there, my job security kind of is irrelevant in this conversation right now. Now, yes, there's risk in that, right? Like you're not doing any of this in isolation to say, oh yeah, that's great, but what happens when interest rates aren't as low? Well, that's what comes down to people being prepared, having buffers in place, releasing a ton of equity that they may already have and thinking, I've got to get all this money out as quick as I can. But those who are finance ready as a cohort and had been through it before, they're the ones who made the lion's share of all this growth.
And the point here is that, and we used the last 5 major downturns to give an indicator of what will happen during this inverted commas down. It wasn't a downturn.
No.
Right? Like, I don't think they'll view this period
2 budget surpluses nationally since then as well.
From 2020 to 2024 as a market downturn. It was a market upturn, but I think the seismic structural changes to how markets operate is what we need to be talking about. So I don't want to be the merchants of doom and gloom, but something like this will happen again in the future. Might not be a pandemic, or it might not be a GFC. It might come in some other guise, right? And you still got people out there saying, there's still got to be a 40% drop in Australian property because
at some stage.
Because if you look elsewhere, it's overvalued, overpriced. I think the most recent numbers was it's 13 times in Sydney the median income. I think Tucker Carlson out of the US has come out saying how can anyone afford to buy property on the east coast of Australia? I can't do it, right? So you still got this analog of, hey, this is how it works globally, so therefore something's wrong with Australia. So everyone's still sitting around waiting for this seismic shift. There will be something in the future that will impact the economy. A black swan event
every 6 to 10 years on average.
Black swan event.
Yep, correct.
Yeah, so you can't be sitting there waiting and planning for it. However, you need to be ready for when it arrives.
And I think probably as, if not more importantly, you need to be ready to withstand it, because the commonality between all these times, if you bought property in 1980, Phil, and you had what happened in 1980, 1981, 1982 to the economy, which was one of the first, the first downturn over the last 5 series of downturns, if you bought then, you're about 10x your money in Sydney.
That's horrible.
This is and at leveraged, if you bought a $100,000 house in Sydney in 1980 with a 20% deposit, you're talking, let's say you took on an $80,000 debt, that property's now worth on average $1 million. That is the scenario that played out.
That debt, if you never find out, is paid down, and
And that's say 40 years ago now, right? But even if that property was refinanced to interest only, and essentially just done nothing with, that's the reality of the compounding. That is the eighth wonder of the world that people need to just remind themselves of, is that you've got to be confident in not only what's happened in the past, but for me, the part which probably gives you the ability to go through the next black swan event, the next GFC, the next COVID, the next .com crash, is going to be making sure that your cash flows are good enough to get through that next one.
Yeah.
Because once they're there, everything else becomes largely irrelevant. If you're comfortable to say, I can afford this, regardless of whether it's really good times, really bad times, if I can afford this one property, if I can afford this 100th property, then I'm good. I'm golden.
And it's around building a sustainable portfolio, right?
Yep.
And everyone's got this sort of ideal portfolio where they don't have to tip anything into it, right? You're not going to do that straight away if you're investing, right? Like
you're only just getting there now, right, Phil?
But even then, I got certain properties that still underperform in terms of cash flow, right?
Yep.
So I need to feed it. So I can feed it.
Yep.
And I sometimes look at my portfolio and go, it's not that good. It could be better. Or I should really do this, that, and the other. And I just go, it's okay.
Yeah.
It's all right. It's okay for the moment, right?
It's better than if you did nothing.
It's better than if I did nothing. However, the point being, there will be another black swan event. However, I would preface that with saying there are different sorts of black swan events. There's going to be black swan events that we have greater control over than other black swan events. Like, we had a lot of control over COVID in many ways because the government had to make decisions, and it had components and resources available to it to make those decisions that it wanted. So just feed the economy with data essentially and stimulus, which it was able to do. It had control out of it. It was a sovereign response to it, and it could actually orchestrate that. Yes, there was consequences to it. We're in it right now. The result of that with this inflationary environment, all this money in the system, et cetera. We don't go into it. But there's going to be other black swan events that we do not have control over. Conflict or war. That's going to be a very tough one. Like, we haven't experienced that war on our doorstep since the 40s, right? 1941. We haven't had that, and hopefully that doesn't come into fruition. However, that will be a very different black swan event, and I think it'd be very hard to forecast how property markets would react and respond to that.
Yep.
Absolutely. I bet it's impossible really to plan for that. You've got to have certain inputs and parameters to shape your decision making, and you'd like to assume a normal-ish economic environment, a normal status quo for Australia. And that is politicians being politicians, messing with stuff and messing up. You know what? We can control most of that stuff. And fortunately, the bureaucratic engine of Australia is largely bigger and more robust than the politics of the day. The Reserve Bank of Australia, for example, should be acting and operating independent from the needs and whims of the government. You talk about budget surpluses, which is getting bandied around. Look how great economic managers we are. They inherited that, and the reason why they're in surplus is because it was really good times selling stuff elsewhere, right?
Absolutely.
That's what it was. So, you've got to just dissect your political mumbo-jumbo with the realities and inherent nature of how and where we operate. So in terms of preparing for black swan events, I wouldn't make that a primary – if a list of your strategic drivers for shaping your property portfolio, preparing for black swan events probably shouldn't be number 1, 2 or 3.
No.
However, if you do all the right stuff strategically, you can buttress yourself from black swan events.
Yeah, and I mean, like I think take that term out of the whole planning vernacular.
Yeah.
You're essentially saying, look, how do I hold a portfolio with higher interest rates and the potential of loss of income for myself? Yep. Maybe add in a variation of some vacancy of my property. They're probably the 3 things that allow you to understand can you or can't you afford your property, and if you can't afford it, how long can you afford it for if all these things play out at the same time. However these things play out, they'll play out differently at different times. One thing that's constant and that we try to demonstrate with the data of historical data is that if you can get through it, the reality is that your property will appreciate in value. That is probably the commonality over the decades that has played out time and time again. The one thing that will dissect the haves and the have-nots is that, did you stay in the game? If you stay in the game.
How many people offloaded stuff that you know of during that period, where during March, April, and May they're going quick? Because that was the idea of what was going to drive down property prices. That there's got to be a glut of properties on the market.
Exactly. Yeah. And again, going back to that webcast, people should really tune into it, because we talked about that. We said, look, here's probably the thing that's unknown, is that how much stock will come to the market in the next 2-3 months, because the expectation was there's going to be this flood of property, because people are like, I can't afford it. I just bought this house. I've got a 90% LVR. What happens if I lose my job? I've got to sell it. That was the thought that would play out.
And by memory, we spoke about liquidity there and property as an asset class versus other asset classes. Now, if you go back to March of 2020, look at any stock. I was only doing this the other day. Look what happened over a period of like a week.
Yeah.
You know, it just fell off a cliff, right?
Tanked.
And I think we were using that positioning at that point in time, saying it's actually harder to liquidate property. It takes time.
Absolutely.
It takes time. And that itself is one of the inherent positives of residential and commercial. Residential property as an investment. Like if people went, oh my God, like everything's the sky's falling. I need to get rid of everything. It's still going to take you 60, 90 days to do that. And by that point in time, you go, oh, sort of, I think it's okay.
That's kind of what happened.
Sort of all right.
That's exactly it.
So structurally, it stopped people from offloading property.
Absolutely.
And the Commonwealth Bank and other banks got it completely wrong, thinking that the speed of change wasn't possible.
Yeah,
at that point in time,
and it reinforced essentially the Aussie dream of the fact that that's the last thing that people will get rid of is their home. You know, everything else will be sacrificed until they cannot sacrifice anymore. They're like, we have to get rid of it. And to answer your question, how many people sold property for us? I mean, I did spend a couple of months there, spending a lot of time with existing clients who had investments, just talking to them about their existing portfolios and just explaining the numbers to them.
Just hold on.
And it wasn't properties that we bought like in the last month or even the last 6 months. It was properties that we might have bought 3, 4, 5 years ago. And they're saying, Paul, I don't know if I can afford to hold this. What happens if this happens? What happens? And then you have to break it down. You have to go from line by line saying, if this happens, here's where you are. If this happens, here's where you are. But here's the other side to look at it. If this doesn't happen, or if you get through this and yes, you have to sacrifice X, here's what's likely to happen. So you might go through some short-term pain financially. There is certainly going to be a more predictable, longer-term, better outcome. But we did spend time doing that, in addition to about 30, 35% of clients saying, I don't want to buy right now. And unfortunately, you can only show people so much. They have to make their own decisions. And I do catch up with these clients frequently or infrequently.
You go, I told you so.
Well,
I told you so.
I don't have to say it, unfortunately.
They go, why didn't I do it? It's funny, and that's how people react and respond to stuff. And, through that period of time, there was more money ended up in the system.
Yeah.
In offsets and redraws, and it's still there. And this is what people think, like this cost of living crisis. There's still more money in the system today than what there was back then in terms of offsets and redraws. So, hence the reason why you're in this inflationary environment where people are going, well, I've still got a bit of money to spend. Like, interest rates are hurting. And for some people, they're really hurting. But they go, I know so many people have gone on holidays to Europe.
Completely.
Over this break.
And I guess the last thing I'll say on the inflation part is, and the really interesting thing that I think is playing out right now, and this is why I think we're in a bit of a predicament, is that when you look at the three cohorts of Australians, if you've got the sub 20-year-olds versus the 20 to 40-year-olds, and then essentially the baby boomers, in those different stages, that's where the hurt of where we are right now in inflation is actually affecting. I mean, those boomers who are retired, unfortunately, they're the ones who are pushing up this inflation number. Everyone else is actually spending slightly below where that number is.
And this is the criticism of using interest rates as the lever to fight inflation.
It really is. It's hurting the people who don't need to be hurt, and you're essentially punishing the people who are already doing, and they're restricting what they spend. So I guess this is the point, is that if we do see inflation and essentially inflation stays stuck or go up, is an interest rate rise going to change that algorithm? I highly doubt it.
Yeah, it will affect some people, and
it's already affecting them, unfortunately.
And it's got to be a huge political issue if they do go up. Like
it's a tough one, and I think this is it, right? Like, plan to be where the interest rates are today, because we're still pretty close to long-term averages. We're not a long way off. We're slightly above, but we're not a long way off. This is about the norm. Rents are catching up, but they've been slow for 15 years. And yes, rents are contributing to this inflationary figure, but they'll normalise shortly. But this needed to happen because yields were terrible in Australia for a long period of time. They're just getting back to the normal averages.
And I'm seeing on my portfolio, I'm actually now getting rents up to where they should be, and stuff turning into the stuff that I've never refinanced is pretty positive. The stuff that I have refinanced, it's they're catching up. You're getting there, but so rather than just sitting here saying to everyone, "I told you so," what I said back then pretty much happened. What's the point?
Well, the point is, I think, Phil, there's probably 2 points. One of which is don't think short term. And I think if you're going to invest, you will see these events will play out again and again. And don't look at property in isolation and say, I'm looking for a 1 year, 2 year outcome. The second point to this is with specifically the data that we walk through, not necessarily the national data, because we're basically on track to see the national averages are the same as what they were, what we expected them to be within that 30-40% bracket of growth. That's what's happened. Great, fantastic. That's not going to help anyone who's going to make a decision for the next investment or for their first investment. I think if we break down the major capital cities and also the major regions, I think the regions have outperformed. Are they still outperforming? Or if you look at the data, they're probably
Are they
peaked.
still coming off, do you think? Or you reckon?
They're not necessarily coming off per se, I think. But again, the regions are harder to combine because in some East Coast markets, the regions might include 8 to 10 markets, and those 8 to 10 markets perform very differently than just Sydney as an example.
Yeah. And regions are like, you think of regions, you think of, say, New South Wales, you go Burke or Forbes or something. That's a very different region than the Central Coast or the northern rivers and much bigger catchments, etc. But I think what's obvious is those markets had an absolute bull run. That started to pare back once we saw the interest rates increase, and also the normalisation of life, where remote working was never going to be a permanent mainstay. It's sort of now we're finding where and what's going to be hybrid, and I think that sort of impacted the regions because the demand's just not there. Certainly not the cash flow. And also that the cheap money doesn't allow people to hold those second properties, which a lot of people went out and bought a lifestyle property. But I think if we look at the major capitals now, you're looking at there's a huge variance. There's a huge variance. And then you go back to most of these markets over the next 20 years will revert back to the mean. Now, which markets have outperformed, which markets have underperformed over the last 5 years? That in itself, for me, should leave clues to some people if they're sort of saying, hey, I'm a 10, I'm a 20-year investor. Yeah. Where's value right now? Where to put your money today?
Exactly.
Is it Melbourne? I think it's Melbourne.
Yeah, well, it depends where your exposure is.
You've got to fix the government down there first.
But they're trying. They're trying with taxes. They'll come up with another one.
I've spoken about this a fair bit.
The bad PR, in my opinion.
Oh, God. How wrong... But the point is that property is intrinsically connected with
sentiment,
the health and prosperity of Australia and the sentiment of Australians. It's so intrinsically connected, right? So in many ways, inverted commas, it's a gift that keeps on giving, right?
Yeah.
Primarily to the government, and I've looked a lot into this. So over this period of time we're talking about, particularly 23 and 22 financial year, the positive contribution that Australian property investors made to the tax coffers is a blow your mind.
Oh,
at a sort of a cash flow point of view, I think it's about $3 billion positive. At a capital growth, and therefore people realising that through having to pay capital gains tax, it's off the chart. And you think about going back to, we're able to deliver these surpluses.
Yeah.
Property investors helped a lot with that, right?
Stamp duty and capital gains tax is
that's at a federal level, right?
Yeah.
They will pay a federal level. If you listen to certain areas of politics, they'll tell you that property investors are evil. Well, they're actually positively contributing during that period of time, right? Anyway, then at the state level, mate, they just get gouged by the state governments.
Absolutely.
Particularly down in, and this is the point where you look at that, you've got to intersect data with sentiment with what's going on the ground. There's 13 or 14 taxes, I think, connected in with for property investment down in Victoria, and they just keep talking about. I saw a press release coming from REIQ, Real Estate Institute of Queensland, the other day or the other week, and it pretty much said, I think they might be thinking about taxing people's land across all of Australia again in Queensland. That's sort of rearing its head again, and you sit there and just go, how do we raise more money? Oh, let's just tax people
They've
with
got a
property.
sub 1% vacancy rate. Let's go get all the investors to sell their investment properties because that'll change things.
Yeah.
Tell me how that works. But
But I think what we spoke about, that's probably 6 months ago, of what will be the factors that most influence the direction of property markets in Australia in this calendar year. But I think you can expand it out for the next few years.
Yep.
One of them was government intervention in real estate markets through property taxes or incentives, and that's getting played out right now.
Yep.
People aren't incentivised to invest in property in Melbourne, so that may change. There might be some clues there. Something has to change.
Something does have to change, but I think in the meantime, you can't wait, and you can't wait for a decision to be made to then dictate terms. You invest like you do in anything. You ideally invest in predictable outcomes and invest when value presents. And I don't want to exclude markets like Perth as an example. It's been the best performing market over the last 4 years. But again, if you look at its performance over the last 15 years, average annual growth is still well below. I think it's still in the 5s, average compounded annual growth over the last 15 years. Yes, 66% growth over 4 years. Yeah. But if you bought in 2010, it's done worse than Melbourne.
And you heard for a long time.
And exactly. And this is where I think people have to have a mindset to say, don't discount these markets that are growing as well, because you don't go broke making profit. And if a market's growing at 2% monthly or 6% quarterly at the moment, which Perth is as an example, is that going to turn to zero next quarter? No. Unequivocally, I could go out on this podcast today saying, is Perth by the end of this year going to be a negative growth market? Absolutely not.
On a quarterly level?
On a quarterly level, or even on a monthly level. Yeah. I would be highly surprised even by this time next year if it's gone backwards on a monthly or a quarterly level. The inertia in property and the predictability in property is also the benefit of it. It's a hindrance, and I think it's going to hinder Melbourne as a market as well, because it won't turn to a 5% quarterly growth market next quarter just because we're talking about it.
But what I would say in response to that, there will be a period of time where people invest in the Perth market and they're going to see, again, probably a decade of no growth.
Yeah, potentially.
Will
Maybe.
They see? If you look back in, that's what the data tells you.
Well, if you look back at the last period, yes. If you look back at the last 2 periods, when I say periods, so you look between, say, 2012 and 2019, where Perth went backwards by about 25%.
Yeah.
If you go back to between 2000 and 2007, Perth tripled in value in that time. So there's all these different segments. So you've got to think, okay, you're trying to pick a market and you're trying to pick a time. For me, it always comes back down to if you can stay the course, i.e. 15, 20, 25 years, and you buy in some way, shape or form somewhere decent in the cycle and you can afford to hold it, you will do all right. But there's going to be a time where you can do far better than others. And this last 4 years was a great example of if you deployed your money in the correct places and waited 5 years, there's some people there who made way more than others.
So the question I'll ask then is that, looking at these numbers and bringing it back to this idea of the performance of property irrespective of seismic shifts in the market and challenges, right? It's clear that Melbourne hasn't performed as well as the other markets.
Correct.
We sort of touched on some of the reasons why. So, and to your point, that Melbourne has always been the most predictable performer over long historic averages in terms of, right? So things point to something happening in Melbourne at a point in time.
Yeah.
So how wrong could you get it? What's the cost of mistiming a market too early? And I got into Brizzy early. I think you did as well. And sitting there and going, what's going on?
Yeah.
Where is this going? Like, I've just had all this growth
5 years.
Nothing's
just on the back
going
of
on.
Sydney saying, well, property goes up 50% in 4 years. That's the way it works.
Yeah. So what's the cost of investing too early in Melbourne?
Phil, it's very timely because I actually had a review with one of my clients this morning, and he has 24 properties in his portfolio, 2 very large commercial assets. I'll drill this down specifically to one property that he has and that he bought in 2019 as about 14 Ks. I won't give the specific suburb, but about 14 Ks from Melbourne CBD. At that same time, bought 3 properties, 1 in WA, 2 in Brisbane. Now, the one in Melbourne was the highest priced. It was about, I think at the time, we didn't buy it. It was unfortunately through another buyer's agent. We bought the others after that, and you couldn't really measure the success at the time. I think he paid $580,000 for that property. It's worth $710,000 now. It's not gone backwards. Yeah. That was the best part of 5.5 years ago. Now, if you look at average annual growth, it's been about 5%. It hasn't been terrible, but the cash flow on that property is getting about $440 a week still today. That property's burning about $25,000 a year a hole in his pocket. Yeah. Expensive. that aside, he's on a decent income, can afford to hold it. That doesn't necessarily dictate the portfolio. But if you look at what the actual cost and the opportunity cost of that was, there was a property that was bought in Rothwell. There was a property that was bought, I believe, also in Brassall at the same time, so west and north Brisbane. And there was a property that was bought in Forestfield. 3 other properties in Forestfield, in WA, in Perth. 3 other properties, all of them were circa $450 price points. Again, all freestanding established houses, decent blocks of land. The average growth out of those properties, I think the Forestfield property has been recently revalued at $760. The Rothwell properties had a granny flat built on it and is now earning about $1,100 a week, valued at $860. And the Brassall property is now valued at about $640. The Brassall property was bought high 300s. Long story short, those 3 properties have they've doubled in value. So the original purchase prices versus where they are now, essentially they've seen a doubling. So it's about $1.28 million collectively for those 3. They're now worth about $2.5 million.
Yeah.
The difference there is stark. And then you say, okay, well, but measure that in 8 years.
Yeah.
That'll be a different story.
It will be. And you look, and this goes to how you choose to view something will give you a very different picture. Like you're proving a point there.
Yeah,
what you're doing.
You
right?
baited me, Phil.
Yeah, but I know, but you're proving a point at the moment of time, which is okay. It's okay to do that. And it goes to show, I would say, the emphasis that people need to place on diversification.
Massively.
That's what that story is. And you might go back in or go forward a couple of years' time, and you'll pluck out that Melbourne property and that Forestfield property and go, look at those 2 have performed so much better than these 2 properties in Brisbane.
Correct.
So it's...
And this is, I guess, the reason why I brought that scenario up is because the conversation actually came back to he can't move forward because he's priced out from a borrowing capacity standpoint. So the question is sort of saying this Melbourne property is a massive problem for serviceability. I'm reluctant to suggest selling it. And I talk myself out of business when I say that to him because I'm like, I know that would free up probably the equivalent of about $1 million in borrowing capacity if he sold because of the negative cash flow on it, plus obviously the fact that there's been minimal growth. And he's reluctant to want to keep it because it's been a dud before. But if I look at the data, I'm saying, well, you know, you've got through probably the worst 5 years. Yeah. Ideally, you wouldn't have bought it then. You would have bought that probably sooner now rather than then. And the opportunity cost, yes, you can't get that money back, but is there going to be value in you selling that, paying the cost, recycling it?
If you spoke to an accountant, they would argue and going, look, you got your negative 25K on that. You're probably getting some tax.
You are across the other properties, which are
right.
circa slightly positive. So there is some benefits there.
You know, so it just depends how you slice and dice. So I would probably be providing the same counsel. I'd become, hey, look, you've taken a hit. Now,
but you've done it right elsewhere.
You'd be silly to transact out of that because there's going to be costs. You're going to be selling costs. You're going to be buying costs. You know, et cetera.
And don't measure it on the last 5 years. You probably want to say draw a line in the sand and measure the success over the next 5 years because that's probably what's going to play out.
Okay, well, it's a good chat, Paul. It's good. Are you going to bring another guest in next time?
We will. We'll have a very special guest, someone you and I both know very well, and our audience probably knows somewhat well as well. Very intriguing. I'll keep it mysterious, but I'll also keep in the sense that he is a very large-scale property investor. Probably worked with a big cohort who's listening to this podcast as well. God. So exciting, a little bit nerve-wracking as well because I think we're going to take an angle on it that's going to be interesting. We're not going to talk about things that's in his wheelhouse. We'll talk about things that maybe are outside his wheelhouse and we'll mix it up a bit there. But
okay, I think I know who you're referring to. Yeah. I reckon there's a lot of things outside his wheelhouse.
There's an awful lot.
He's very, very good at doing certain things, this guy.
When it comes to conveyancing, he's very good at it.
What's the name of that company?
Yeah, I'm not going to give him a plug. Paul Denny. Yeah. I don't know Paul. He seems to be
very, very good at
used it. Was it Paul Denny Conveyancing? Homer doesn't work here, but no, PK Simpson.
What?
No, I'm thinking of a different. No, it's Paul Denny Conveyancing. I'm thinking of Homer doesn't work here, PK does, but that's a completely different business. Full stop. It's another conveyancing company.
God, tell them the price, son.
Oh God.
All right. So you guys busy?
Look. Yes. But we're probably in a few markets right now.
Who's calling up going, Paul? Mate, I want to have a chat with you. I want to buy some property.
I spend a lot of time with my existing clients, and that's probably where I spend 70-80% of my time, and that's where I like to, and I need to, because that's where our service actually extends to making sure that that's a very important part. But when we're working with existing clients right now, I think those, specifically this data that we just went through today, there's a lot of people who sat on the sidelines for the last few years and are frustrated, but there's also a lot of first-time investors, i.e., young ones who are in their 20s who look at it and say, I wish I could have done something because I really would have wanted to, but maybe I was going through uni or I was starting my career. And there's people who are looking at this and just getting wise. For me, they're the people who I'd love to help because I like to get people on the start of this, in addition to those people who've got those larger portfolios and need to do restructure. Because if we're starting early enough, all this stuff we talk about, reverting to the mean, compounding growth, there's nothing better for me than to see someone who has built a large portfolio on a relatively modest income and 20 years later they get to do what they want because they made some good decisions and were able to hold it. So
give me some sense, like the people that you work with, talk about people with 24 properties or whatever, right? I don't want you to disclose any client information, but like what would be someone's salary or annual earning at the top end that you would work with? Like
at the top end, it's 7 figures.
Yeah.
But I'd say at the bottom end, and for me to give people sort of the understanding that they still can do something. I mean, I've had two clients of mine, siblings, brother and sister, late last week come on board. The brother had worked with us before, but the sister, she's just finished university. I think she's on a graduate salary of $62,000 a year. Yep. Their parents have said yes, they're happy to go guarantor for that first investment, and they're going to invest together because they just have a modest income. And they're 23 and 26, I think, age.
Yeah, good.
They're the people who are on the right track because they're just getting fed the right information, and that they're effectively wanting to sacrifice a bit to earn a lot down the track. Yeah. But the majority of my clients, a vast majority, are couples who usually have their own home and probably have enough equity in that, have got a handle on their mortgage repayments, know they've got a bit of surplus cash, probably spend money on stuff they don't need to, but realise, hey, my super's just not going to cut it. Yeah, we pay off a home in the next 18 years. What then?
So they're like 40-year-olds.
They're typically like early 40s to late 40s, even early to mid 50s. Yeah. And those some have started earlier. They might even be sort of in their 30-year brackets, somewhere in the 30s, may or may not have kids. But they're the ones who, A, can do the most, but B, are usually the busiest. And that's, for me, is probably what it all comes down to, is the too hard basket.
Yeah.
And so many people's like, I was going to do this, I just kept putting off. Our job is, and I've said this so many times to you before, Phil, I find vast majority of our job is to enable things to happen. Are we finding things that don't exist or that the average Joe can't find? No, for the most part, these are in plain sight of day. Yeah. It's just our job is to enable the outcome and make it happen.
And you know what? That's a really important point. I'll close with this in that, and I've been vocal on this previously, and that is the role of the buyer. I've knocked around buyer's agency for some time, right? And I buy stuff myself. I'm probably not a bad investor. I'm sure if I didn't do this for a living, I could become a buyer's agent. I don't want to. And I've seen the growth of the buyer's agency sector. The buyer's agency sector needs to be very, very careful because what you've explained, what buyer's agents do, and what you guys do is probably very different to what a lot of people who aren't familiar with buyer's agents would assume buyer's agents do by looking at their social media. Yeah. And you would think that the role of a buyer's agent is a real linear, hey, I'll buy your house cheaper than what you can buy it for. Fucking, that's not it. Pardon the French. No. And I never swear on this podcast, but that's not that's a small fraction. Yeah. A small fraction of what it is.
Completely.
And you've got to be clear on that. So that's the difference between a property strategist and a portfolio strategist. And, part of that is acquiring properties, but it's everything else that's important.
Absolutely. And mate, you absolutely hit the nail on the head there, that anyone who thinks that going and paying money to a buyer's agency means that they're going to get a secret sauce or get a property that no one else can. Look, yeah, you might, around the edges, you might get a little bit of a deal. Our job is to not worry too much about talking under market value or any other catchphrases that sort of fall into that phrase or into that terminology. It's more, hey, here's where you are, here's where you want to get to, here's what you need to do to get there. Yeah. So let's go and action this.
You're paying for an enablement, you're paying for execution.
And we'll make sure we don't stuff it up along the way.
And that's a really important point. And if you're tuning into this, that's the point to take away from it. That's the boring bit.
Yeah, that's the doing.
You guys look after the boring bit, whereas most people think buyer's agency investing in properties. Yes, I've got this property. Oh, it's 20 grand under market value. And, oh, look, I'm a genius. Yeah. Move on. Anyway, how do people find you guys?
purepropertyinvestment.com, Instagram, socials, LinkedIn, Facebook, whatever they're on these days. We're everywhere. But go to purepropertyinvestment.com or give us a call on 1300 985428.
Trained operators are standing by.
Trained operators are standing by. That's my team.
What happens if I call that number? I might call
give it a crack. If you're listening to this, give it a crack right now. 1300 985428, and I want you to report back to
Smart. Do you want me to do it live?
Do it right now.
Okay.
Let's put it on speaker.
Okay,
this could be
this
very, very nerve-wracking for me. I'll tell you right now. Oh, what time is it? Is it not lunchtime, is it? It's a bit after.
1:40. That's the best time to call. What time? 1300
98.
Don't worry, we'll cut this out at 1300
9854.
Wait, 98
5428.
28. 1300
985 428.
Okay, Paul's quickly texting someone to make sure. Here we go. It's live on air.
Oh, is it on the speaker? Oh my goodness, I can actually hear it as well. It's going to go. Oh, what's that? 3 rings? 4 rings? 5 rings. Here we go. It's going to get. There's a voicemail coming up. Oh, I've made a fool of myself.
Come on.
Oh, I've just got a message. Sorry, I'm at lunch. Back in 5. Oh, of all timings.
Yeah.
Thank you for calling Pure Property Investment. We are sorry we missed your call at this time. Please leave your name and number, and we will give you a call back the following business day. Thank you so much.
Please leave a detailed message after the tone. When you have finished recording, you may hang up or press 1 for more options.
G'day, it's Phil Tarrant here. I'm currently on the Pure Property podcast with Paul Glossop, and I was interested to chat with someone. Can you please give me a call? 1-800, I'm desperate. Thank you.
I want to know what 1-800 I'm desperate actually spells now.
Imagine that. And it's up to you whether or not you want to keep this in a podcast. But I think this is the really organic and pure way that these things happen.
Keep it there, mate.
Do you want to do it?
No, absolutely. We'll report back.
All right, report back and see what happens.
No, that's all good.
Well, thanks, mate. Thanks for being good fun as well. The Pure Property podcast with Paul Glossop. I really enjoy this podcast. It's a big highlight of me to record this with Paul every month. And we get stuck into it, and we'll do more of it. Thanks for tuning in. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.